Hi class, welcome to the 7th week of Accounting 103. Today we're going to talk about tangible fixed assets and depreciating fixed assets. If you recall from week 1, chapter 1, we talked about assets, and we said that assets were something of value that's owned by a business or an individual. We talked about current assets, and we used the acronym CAMPI for cash, accounts receivables, marketable securities, prepaid expenses, and inventory. We also briefly discussed our long-term assets, and we used the acronym BAFL. BAFL stands for buildings, automobiles and other transportation, furniture, fixtures, land, and equipment. Of all these fixed assets, only land does not get depreciated. Land is something that is treated as always existing and always having value for a business. The other assets that are long-term in nature, buildings, autos, furniture, fixtures, and equipment, all have a useful life. Eventually, these assets become obsolete or just become invaluable to us because it loses its value over time. It gets worn out. As you all know, if you buy a new car, everybody's excited that the car is brand new, shiny, but 10 years later, it doesn't have that same appeal. Why? Because it wears out. It gets old. And therefore, in accounting, we have to reflect the fact that the asset that we bought 10 years ago isn't necessarily worth that amount today. So we call that depreciation. And we have to record depreciation at the time that we prepare financial statements. And that could be monthly, quarterly, or annually. We depreciate an asset by recording it to an expense. We call it depreciation expense. We debit depreciation expense, and we credit an account called accumulated depreciation. Over the course of time, the accumulated depreciation account continues to grow. The accumulated depreciation account is considered a contra asset account, and the depreciation expense account is closed out every year to retained earnings. So for example, if we have a car that we buy for $30,000 today, we assign a 5-year useful life for automobiles, and that's whether or not the car actually lasts 5 years, 10 years, 15 years, it doesn't really matter. But we're allowed to depreciate a vehicle over a 5-year period of time. And what we would do is take the $30,000 cost divided by the useful life, which is 5 years, and therefore depreciation expense would be $6,000 a year. This $6,000 depreciation expense is recorded on our income statement and reduces our net income, which means it also reduces our income taxes. Buildings have a longer useful life. If it's rental property, that's residential, it can be depreciated on a 27.5-year basis. If it's commercial real estate that's rented out, it could be depreciated over 31.5 years. Furniture and fixtures are depreciated over 7 years, and equipment is depreciated over 5 years. That's all I want to cover today about tangible fixed assets and depreciation, and I look forward to seeing you all next week. Thank you.